Well, we want to find out what's next for China. No better person to speak to than Stephen Roach of Morgan Stanley Asia. Thank you so much for coming in today.
Good to see you, Margaret.
Good to see you. I mean, exactly here. 2.7% sounds very close to that 3% target. Does that mean we're going to see a policy change next month?
Look, first of all, the comparisons, Margaret, on inflation, exports, industrial output, GDP, they're coming off of rock bottom levels from a year ago. And so China's clearly mindful of the fact that as the global economy bounces, and this export machine is a levered play on the global economy, it's going to bounce as well. Looking beyond the first half of the year, I think China still has a lot of questions about economic prospects going forward. They're not going to be aggressive on policy here. But yes, they're prepared to begin to head to the exit strategies. They raised bank reserve requirements twice in the first 2 months of this year. They may make a small move on the currency. They've indicated that they're not going to be increasing their fiscal stimulus going forward. When you have a strong economy, you do not need emergency measures on the fiscal and monetary front to support it, and the Chinese are mindful of this.
Would April, which is a month that keeps getting repeated in terms of a potential policy change, when you talk to a lot of strategists, would that be too soon?
I think April is also the year when the U.S. issues its twice yearly foreign exchange report. The Chinese want to avoid being labeled a currency manipulator. They may make a small move on the currency. I think it would be premature for them to move on interest rates at that point, but certainly they could do more in the way of curtailing excess bank lending by further increases in bank reserve ratios.
Yeah, because certainly the headline of a 16-month high sounds scary there. But do you think those concerns and the reverberations we've seen in the emerging markets in today's trading session, do you mean that it's sort of overdone, too much of a knee-jerk reaction?
Yeah, I think, the idea of a 16-month high is, again, you have to put it in context of where we've been over the last 16 months. This has not been a great 16-month period for anyone. China's been more resilient than any other major economy in the world, but the idea that this is an overheated economy, I think, is very much overblown.
You mentioned perhaps a small move when it comes to currency. When you look at the yuan, the question is how much of a move would the Chinese government allow if they do allow the yuan to appreciate?
Hard to know, but my guess is somewhere in the 2 to 3% area would not be unreasonable. Whatever the move is, it's going to be well short of that of the sort of Washington politicians continue to beat on China for a big move. This is a country that still remains very dependent on the export machine to sustain economic growth, employment, and maintain social stability.
And you're concerned about protectionism. I remember a conversation we had a few months ago where we started to see that bubble up a little bit.
Look, the developed world has still got a 10% unemployment rate, relatively stagnant real wages for its workforce, and they believe that China is responsible for a lot of the pressures bearing down on its workers. As we go toward the midterm elections in the U.S., the protectionist drumbeat is something to take fairly seriously.
We've got a few more minutes now with Morgan Stanley Asia Chairman Stephen Roach. We've talked through the news of the day, but bigger picture here, the question about the reliance on the United States buying Chinese-made products continues to float out there as we try to figure out how far through recovery the United States is. But the buzz is all about this fabled Chinese consumers finally starting to buy. When are we going to see that?
It's not here yet, Margaret. Consumption last year fell to 35% of Chinese GDP, half the excessive 71% in the United States. But the big move for China over the next 5 to 6 years is that the dynamic needs to shift from the export sector to 1.3 billion Chinese consumers. They need a lot of things to do that. They've got to build the safety net. They've got to come up with new sources of job creation, and they've got to provide stimulus to their rural population, which numbers roughly around 850 million Chinese people. This is a critical piece of the equation.
Now, we often talk about the Chinese consumer as this monolith, just people there we're hoping to start buying. There's a great piece in the FT today by David Pilling talking about, though, the rural exodus, that new wave of potential consumers coming in from rural areas into the major cities, but that their social status alone, there's a different social contract. They don't have the same safety nets socially, access to education, access to the same resources that people living in the cities are guaranteed in some ways by the government. I mean, how real is that concern about social contracts?
I think David makes a really important point in his piece today. Since the year 2000, between 15 and 20 million rural citizens have moved into urban settings. That's like 2 New York cities a year. And the lack of a safety net, not just for them, but for broad-based Chinese residents, is something that is a profound drag on Chinese consumption. Chinese people save a lot because they don't have a safety net. The Social Security system is inadequate. So is private pensions, medical insurance, and unemployment insurance. And a big challenge for China in the next 5-year plan, which will be enacted a year from now, is to build out the social safety net. If they do that, they can bring down excessive levels of fear-driven precautionary saving and stimulate internal private consumption.
And there were some gestures towards that coming out of their State of the Union from Premier Zhibao saying that there will be some changes being made to social policies.
There were some incremental gestures made on that behalf. I think they've got to come up with a much broader commitment. The Social Security system in China, for example, has $110 billion of assets under management. If you do the math, that works out to $130 per worker of lifetime Social Security benefits. Wow. Money goes a long way in China, but that's not enough.
That's not enough.
Doesn't do it.
So this buzz about a property bubble existing in China, Jim Chanos, a number of very well-known investors have raised questions about it, pointing out things like 20% of office space is vacant in Beijing, 16% in Shanghai. Those numbers attributable to CB Ellis. Is it pre-building for this exodus, or is this a bubble that's forming in property space there?
The fears of a bubble are vastly overblown in China. Again, the demand for shelter, the demand for office space in a nation that does rural-urban migration of 15 to 20 million people per year, that demand is there. No country has such demand for urban dwellings and urban office space as China. From time to time, the markets get ahead of themselves, and this is one of these times, fueled by the bank lending and liquidity boom post-crisis. The Chinese authorities are on top of it. They're clamping down on excessive bank lending, and I think unlike the U.S., which lets bubbles get out of hand and distorts the economy, that's not the case in China.
All right. Thank you so much for your perspective.
Thank you, Margaret.
Always great to have you on the show. Stephen Roach of Morgan Stanley Asia.